when you look at, the chessboard, as I call it, right, the U.S. economy and the changes that Trump administration and the like are doing, you can't get to where they want to go without having a lot of chaos and churn in messaging.
Yeah.
And the output of that, again, I think is twofold. I think the average consumer is more scared today than they were before because, again, they don't know. They're exhausted from the last 4 years, and they're just beaten down, and they aren't seeing the immediate turn of the dials like maybe some of them hoped. Folks, I don't know if you are paying attention, but the 10-year note has gone from 4.78 on January 13th to currently 4.3. Rough and tough, folks. That is a 50 basis point move or half a point. Mortgage rates are following. Mortgage rates were just over 7% seemingly a week ago. They could be under 6.8 today. Likely so. We'll see a report after lunch. But we're going to talk about what the heck is going on. Why are mortgage rates crashing? Is it something you need to be concerned about? Is it the goal? We're going to have this conversation with the one and only Anna Kelly. Anna, how you doing?
I'm doing great. Good to be here with you.
Yes, nice to be here with you as well. So I know you've been out and about. You had a 5-day event with your lovely daughter who, oh, by the way, folks, won the gold medal on bars. Let's shout out one and only for winning the gold medal. But yeah, I don't know if you had a chance to see it, but yeah, mortgage rates crashing, 10-year note down big time. What's going on, you think?
It's interesting to watch because the bond market is really a big deal. It's a bigger deal than the stock market is, quite frankly, when it comes to kind of foreshadowing what might be coming. Some of it's obviously reacting to what they think, but the 10-year market kind of tells you what the big money thinks about where things are going in the next several years. So it's not necessarily where do they think things are going to be, in a couple of months, but they definitely, I think, are a better leading indicator than the stock market is, where the stock market used to be known as a leading indicator. And you'll have old school investors, financial advisors, of the 70s and 80s say, oh, the market's a leading indicator. If the stock market's great, then that means the whole economy is going to be great. It doesn't work that way anymore, right? Because the stock market's so disconnected. But I think, part of the issue that we saw when the Fed cut the federal funds rate, which we were all waiting for and hoping, rates would start coming down as inflation started coming down. When they cut rates, the bond market actually reacted by demanding higher yields, which, causes the bond yields to go up. And basically they were worried about inflation. What's interesting now is even though we've had a fairly higher inflation print than what people wanted to see, both in CPI and PPE recently, I think the bond market's starting to see some softening and getting a little more nervous that before we have an increase in inflation, we might actually have that recession everybody kind of thought would happen before. So you're seeing some kind of softening in the labor markets. You've seen some big layoffs, Starbucks, Southwest Airlines in Dallas, along with some others that had gone into kind of a restructuring bankruptcy that are now going into all-out bankruptcy. And so I think you're starting to see the bond market react more so than the geopolitical stuff, which still brings a lot of uncertainty. They're worried about that. But I think that what they're nervous about is that the consumer is finally kind of tapping out, that companies can no longer push those profits through, and that could create some softening, and we might have the recession this year. And if so, they're going to demand lower rates than they were if inflation was a really big feature, no longer a bug, but was going to be here for, with us, especially over the next year, but into longer than that as well.
Yeah, it's such an interesting conversation because, again, the thing I want to go back to is the Fed did cut rates 100 basis points, the federal funds rates 100 basis points. And then the long end, the 10-year went up basically 100 basis points. So there was a 200-point divergence.
Yeah.
So to your point about the bond market kind of being a leading indicator, maybe what the bond market is doing is it's kind of backing off of that just monster spread, right? It was a 200-point move and now it's 150 or something.
Mm-hmm.
Maybe they're coming back more in line. But this really started in earnest last Friday when we had a report, I think it was PMI services, showed that the service sector, the service portion of the economy, was in contraction.
Yep.
And, I think that was kind of oh, wait, maybe the economy is not as strong as it looks. Oh, wait, we have had some pretty significant layoffs, and obviously the layoffs going on in the federal government right now can't be forgotten as well, besides Southwest and
Right.
others. I think what I really think is going on, and I think I said this on my daily financial news today, is I think President Trump is actually losing the consumer. What do I mean by that? Right, the consumer drives the economy. I think President Trump enjoyed a 1 month kind of momentum, and like, oh great, there's change. They're gone, we're here, everything's great, it's going to be wonderful. But the average consumer is not steeped in economics. They're not steeped
Right.
in understanding how the chessboard is being moved. And the average consumer, Anna, is hearing the word tariff probably more in the last 30 days than they've heard in their entire life. And the average consumer hears the word tariff, and their mind's just going to think it's a tax, it's a price hike. I mean, they don't understand fairer trade. They don't understand bringing they're not looking at the bigger picture. The average consumer has been suffering with inflation for 2.5 years now, and they're tired. They're just tired. And, now the president saying the word tariff, or they're hearing the word tariff, more than they ever have. And they're like, great, that's just what I need. So I think he's at risk of losing the battle in order to win the bigger war. What do you think?
Yeah, I don't know, Michael. I mean, I agree with you that the consumer is by and large pretty uneducated about the economy. And so maybe they're a little more reflexive to fear mongering if they may see it on, social media or on the news. What's interesting to me is that, you and I have talked about on this show many, many times that there's lags to the economy. What we're seeing today is a reflection of where things were for policy, both fiscal and monetary, a year to a year and a half ago, right? So these things take lags. It take a long time. And sometimes these, the economists like to say long and variable lags. They're long and they vary, and we never know how long they're going to be. But I just don't tend to give as much credence to the politician as what's making the consumer, do what it's done. I think the consumer has been tapped out for a very long time. But I've been arguing the reason that I believe that we're in recession already is because the average consumer, the 70% of the people that live check to check, they've been pulling back already for quite some time. Now they do the revenge spending at Christmas. They go and put it all on their credit cards. And we saw a big increase in those credit card balances, even though consumers kept to spend, in the fourth quarter. And that, no doubt drove up some prices and some inflation. But I think generally speaking, I did see a quick headline, and I have to be honest, I didn't read the whole article because of my gymnastics meet, but that the data was now showing what people had been saying. It's that 50% of consumer spending was driven by the top 10% income earners in the country. And this is what we've called this very bifurcated economy. So I don't think that it's true that the consumers just suddenly got scared because of the word tariff. I'm just going to push back a little bit. You may be totally right. But I think most consumers aren't really watching, and they don't really understand. And they're like, that's overseas, not impacting me, unless they're listening to far left news that's like, this is not bringing down your cost of eggs. And I heard the ladies on The View, a little sound clip, say that. You're going to have some that are like, yes, I thought Trump was going to bring down the cost of eggs, and it didn't. And so they get a little nervous. But I think most people aren't thinking about that in their day-to-day spending. I just don't. I think they've already been tapped out. They are tapped out, and it's just finally showing in the data. And to your point where, services is coming down, the economy's really been floated by services inflation, services spending, as well as services inflation. So even though the cost of services has gone up, people haven't given up, spending on services, travel, restaurants, things of that nature. But a lot of our inflation, we've actually seen some deflationary activity in goods. The increases have been in services, things like your healthcare, your health insurance, and things of that nature. And that when that top 10% is what's been floating it, and they start pulling back, as data that I read about a week to 2 weeks ago said that they were doing, I think that's what's really happening, is that top 10% is slowing down their spending on services. They're starting to actually pull back. And the 70% that's check to check, also that has those high interest credit card balances. And Michael, don't forget, I don't hear a lot of people talking about this, but student loan repayments just started reporting to credit companies. So people that have not had to pay their student loans for 4 years, I see it day to day as we get rental applications for our properties. All of a sudden, people are downsizing their rent, what they can pay. And now they've got $600 a month school loan payments, $2,000 a month school loan payments, and they're not meeting their debt to income ratios even to rent an apartment any longer. So I think it's long term. I think that this has been we're in a culmination of what we've been through the last couple of years. As much as, I'm pretty, like I've talked about, I'm not a MAGA Trumper. I'm pretty, moderate conservative. I don't like a lot of things he does, but I don't think we can blame him on the consumer pulling back and going into a recession, although I know that's what a lot of people would like to do.
Yeah, no, I mean, I guess, again, he's been in office for, I don't know, let's call it 6 weeks or so. I think blaming him for anything in 6 weeks is pretty nuts. But but that said, I don't think it's unrealistic, and I'll certainly put it out there that, what can happen inside of 6 weeks is the average consumer can start to pull back. And that's what happens with messaging. I do think this is a messaging problem. And again, I mean, let's be clear, right? There were lots of promises made coming in, and I remember on many occasions, I'm going to fix inflation day one. Right now, anybody who understands inflation or the economy realized that was complete hyperbole. But I think a lot of people believed it at face value, and now we're 6 weeks in, and you're flashing egg prices everywhere.
I agree with you there. I think the messaging, love him or hate him, his messaging is very hyperbolic. It's very, I'm the best president and I'm going to get the inflation the lowest that it's ever been, and nothing would happen if I were president, and all those kind of things. Those that do believe it, and maybe we're hanging on, and we're cheering in November and are like, uh-oh, all these things I'm hearing, groceries are still not coming down. I'm scared of the tariffs. Maybe that is making them go, okay, he can't save us. They shouldn't have believed it was going to happen like that, in the first place. But I do tend to agree with you now that you're saying that. I think there's a lot of people that just thought it's going to be overnight because they don't understand. And, I think people who do have money, who've been keeping the economy afloat, I think they're more scared of the tariffs. I was quite surprised at how high the tariffs were so quickly. And again, he's using some of this as bargaining chips rather than actually going to put high tariffs in on everything. But I think that there is some fear in people that do have money that, this could, keep inflation going. But again, this kind of reversal of the market, the bond market is telling you that the rich money, smart money, as they call it, they're seeing softening. So they are worried that consumers, both wealthy and not wealthy, are pulling back to the extent, and if tariffs come through and that cost is absorbed by, companies here that have to start raising prices, I think they're more nervous now about a recession in the short term than they were. And I think rightly so. I think they should have been more nervous about it before. But again, when you look at the bond market, they're looking out 10 years and, 5 to 10 years. And so there's a lot of bumpiness that can happen in between. And this is kind of what I argued, you and I talked about a few weeks ago on the show, is that we've got to expect a lot of volatility, and consumers don't like volatility. The stock market doesn't like volatility. the bond market doesn't like volatility. They want to be able to predict and see it a smooth line, into an expansion. So I think there's a lot of things that are happening that they like that Trump is doing, such as, okay, let's talk about renewing the tax cuts of 2017. Let's talk about some corporate tax cuts. Let's talk about cutting expenses with Doge. They like that, but then the tariffs seem to be kind of counterproductive to inflation. And they're seeing this tapped out consumer. And I think they're just nervous about how long is it going to be? How bad is it going to be before maybe we have a recession? How bad is unemployment going to get? I think they're still nervous about inflation for the longer term, especially with tariffs, but there's a lot of headwinds and a lot of tailwinds. And so they're trying to make sense of which one's going to win out. Are we actually going to keep this soft landing they were celebrating just 2 weeks ago? Or are we going to get some bumps, have the recession, and then can Trump, and Congress get us out of it more quickly? So I look at this as just some recognizing that there is more softening than what people wanted to believe. And to your point, that Trump isn't going to snap his fingers and it's magically, going to result in this amazing expansion where GDP is so high so quickly without inflation, also staying high.
Yeah, I think we're just in it. I mean, when you look at, the chessboard, as I call it, right, the U.S. economy and the changes that Trump administration and the like are doing, you can't get to where they want to go without having a lot of chaos and churn in messaging. Yeah. And the output of that, again, I think is twofold. I think the average consumer is more scared today than they were before because, again, they don't know. They're exhausted from the last 4 years and they're just beaten down, and they aren't seeing the immediate turn of the dials like maybe some of them hoped. But the other point is you got to watch businesses, right?
Sure.
Businesses are being forced to react and plan for probably multiple outcomes. I mean, I've read multiple reports on tariffs from Mexico and Canada. Now, again, I believe this is nothing more than noise and negotiations. And, we'll find out next week because they end in the first week of March. If I'm right, they'll be suddenly delayed till April is my guess. But the auto dealers have told us quite clearly that, you're going to see somewhere between $3,000 and $4,000 increase in car prices, parts. Home builders are saying it could be $6,000 to $8,000 a home because of these are real numbers.
Yeah.
Right. And that's again what the consumers are seeing. But if you're a business and you have this risk that's out there a week and then it's delayed again, and how do you plan around that? All you can do is you're just going to take your investment horizon and you're going to shorten it to the smallest window you can, and you'll just make incremental changes because you don't want to go buy a 1,000-acre parcel that's going to take you 5 years to develop when you could be eating an $8,000 tariff cost, right? You're going to go do a 20-acre parcel, and it's just so. And
what's the fastest way to cut expenses? It's to cut headcount, and they've been reluctant to do that, especially post-COVID. When it was very hard to find skilled workers, and there's a cost in training, your employees, whether you're in, blue collar on an assembly line or whether you're white collar. And so they've really done what they can to kind of hold out, to keep from cutting headcount by and large, economy wide. I mean, we've seen it, and we're starting to see it in certain sectors as well. We've talked about kind of being in something similar to rolling recessions where we saw it in manufacturing and in housing. And now you're starting to see it, kind of in that services sector. So a lot of companies, though, if you looked at surveys of the last quarter, and this is where I was really trying to say, I think there's more softening than what people want to say. Usually layoffs start to be really thought through and announced in January into February. At the end of the year, they're hoping to have positive earnings projections and to keep their stock market go, but then they start really realizing, okay, we're going to have to see where things go. And I think a lot of companies, to your point, were waiting to see who would win the administration, both Congress and the presidency, to see where things might go. And so now they're just starting to kind of grapple with, where are things going? Can we push through these costs to the consumer? And I think these companies are saying, hey, consumers are starting to pull back. Those that have money are starting to pull back. And we're going to have an increase in our input costs, especially things like steel. So to your point, cars, housing, those things are just going to get more expensive. And so they're not going to be able to absorb. Now, some will, but most probably won't be able to absorb all of that cost. And so to your point, they have to push through what they can, but they've really got to start getting really lean on their expenses. So I expect to see more layoffs. And I think, even investors in the stock market are starting to get nervous. I mean, you saw last week, we had several really sharp down days. Not correction territory, but this is what I was kind of talking about with stock markets, or the stock market's priced to perfection. It's the lowest risk premium we've seen in, many ups and down cycles, where you're not being paid a whole lot in terms of future expectations of earnings on the price per share. And I think, the markets are starting to realize that the tariffs are something that really could impact profitability. And so the shareholders of these companies are like, we've got to do something to get at least close. And that's going to come through cost cuts if they can't push through those prices to consumers. So I think the bond market's recognizing that. What's a little surprising to me, and why I'm not necessarily saying that we're going into a sharp recession quickly. I mean, I think we're in a recession. I don't know that how deep it's going to go, or how fast we might be coming out of it. So it's hard to tell with all these different blips as these recessions kind of roll through different segments of the economy. But something that I'm surprised about. I'm surprised how low the 10-year has dropped so quickly, even though I think they're starting to recognize some of these things, because the inflation risks longer term have not gone away.
They've only gone up. The inflation expectation, 5-year inflation expectation took the largest. You missed this report because your daughter's gymnastics.
Yeah.
But it was the largest rise in 5-year expectations since like 1995.
Yeah, and if you annualize, the CPI print, even though it was it's a 1-month increase, but if you annualize it and CPI continued to do what it did in it's like a 6% inflation rate on a 12-month perspective. So there's a lot of things that are pulling the cost of goods down, and if oil prices can come down, that can cause more disinflation in goods. But you've also got again, services, since there's some pullback that could kind of bring some of that down, especially if the higher end stops spending. But what is interesting to me is the bond market really does watch fiscal policy, because they understand that fiscal policy can have much bigger impacts in an era of high debt to GDP, high government debt, than the Fed funds rate or monetary policy and what the Fed does. And so even though, there's pressure on the Fed to cut rates, if you look at, let's talk about Ray Dalio's key for how do you get, global debt under control? How do you get a country's debt under control? And when your debt to GDP is as high as ours, you really have to do a few things to get things on the right track, although it takes years to get there. One is you've got to create austerity. Okay, well, Trump is doing that with DOGE. It means they're cutting back on what they fund at the federal level. So like it or not, like how it's being done or not, I like some of it. I don't like how some of it's being done. It doesn't really matter. But what people need to recognize is they're instituting austerity, cutting what they can for now. Some will say those cuts don't go deep enough. The next thing, other than pulling back spending, is they have to generally raise the tax base. They've got to raise taxes. So while Trump is trying to raise taxes through tariffs, and this is part of the balance of how much is he bluffing and how much is he serious, I think there's some bluffing, but there's some seriousness as well that says in order for us to cut taxes or continue the 2017 Trump, tax cuts and implement some additional tax cuts to things like Social Security, wages, tips, and things of that nature, and to put in some corporate tax cuts, they've got to basically create a new tax base through tariffs or have other ways to create more taxes by increasing GDP. So they're cutting taxes, which is kind of the opposite of what the bond market wants to see for getting the debt down. But that means they've got to produce enough GDP, new production. And Trump is doing things to try to bring back investment here. Apple just announced they're going to do major investments, several tech companies, AI companies, Japan, I think it was Honda, if I'm not mistaken. No, it was Toyota, that's going to bring, some manufacturing back here. So he's doing things to try to get GDP up. But the fact that there is a potential for big tax cuts instead of tax increases means that the debt's going to have to go up a little longer before he's able to really stop adding to the debt. And generally what that means is the only alternative is allow more inflation, because if you allow more inflation without telling people you're allowing the inflation, which is what's been happening to us for decades, but could get worse. If you allow more inflation, then it becomes cheaper in the future with cheaper dollars to pay off today's debts. And so I'm surprised the bond market isn't saying, yeah, we see this stuff. We see that we might go through a recession or some bumpiness in the next year or two. But if we don't collect a lot more with tariffs and get a lot more productivity, we know there's going to be more inflation, and therefore they're not coming off of that 4.75% market. So I'm a little surprised. I know they're smart money, but I'm a little surprised that rates have come back this far in the last week, knowing that those risks have not gone away, Michael, regardless of what the consumer does and regardless if we have some softening. So it tells me they're confused, and we just don't know how. None of the economists know how. The good ones are humble enough to say, we don't know the balance of those risks of how bad and how far can a recession be that could keep that GDP from being stoked, and how bad is that inflation going to get, balanced with the unemployment risk. So I wouldn't be surprised, Michael, if we see a whiplash and the rates go right back up. So if you're one that's watching rates and thinking about locking in, don't think that it's smooth sailing and mortgage rates are just going to keep going down and we're going to be, in great shape as investors looking for low interest rates. I think they'll come down if we have a recession, for sure. And then the Fed will cut rates as well, which will be really good for commercial investors. But be careful what you wish for, because it comes through recession. And the question is, how bad does it get before things start to expand again? I think there's a lot of volatility ahead.
Yeah, it's really an interesting thing, because again, I totally agree. The bond market is thinking many years ahead. The one thing I wanted to postulate, just an idea.
Mm-hmm.
One of the things that I believe the bond market might be telling us is that they have belief that Doge and tariffs will be incrementally successful. What do I mean by that?
Yes.
Heading into this year, we were clearly on an unsustainable path. $2 trillion in extra spending over what we're taking in is unsustainable.
Right. Absolutely.
Just full stop. And I believe heading into this year, the bond market was screaming, you're not paying attention.
Yeah.
So I think what the bond market actually might be telling us is that they see Doge spending cuts and tariffs, more revenue.
Yes.
As bending the curve.
Yeah.
Because again, if 2 trillion is the number, right? All they have to do is probably find $1 trillion. And then what's just going to happen, and I think we're seeing it today in the bond market, is the yields will come in. And then the simple act of the yields coming in will make that 2 trillion fall again. Because one of the reasons we are spending 2 trillion more than we have coming in is because the debt costs are going higher.
That's a very good point. Absolutely. Yeah. And I think you're right, in that regard. And so they must be confident enough to go, he wasn't messing around with Doge. Like, as much as, there's a lot of screaming on how it's happening. The other thing last week that happened, and I just saw, again, the headlines, but multiple lawsuits against Doge. The presidency prevailed, and the judges were like, you can say that there's a risk that they will use this data, but you have no evidence that they're actually doing anything wrong. And so, even pretty liberal judges sided with Trump, which means Doge can keep moving forward with what they do. And when bond markets want certainty and they say, hey, this isn't going to be caught up in the courts forever, they may be able to continue to do this. I think that probably did give them some confidence last week to go, They're
Yeah.
already making big progress that, he's not messing around. And the Trump's tariffs, at least the reciprocal level, he's pretty much, proving that we're not backing off of this. Now, he may back off of a little bit, with Mexico and Canada in terms of the percentage, that 25, but I think they're getting the confidence to say he really is pushing that. And the other thing that happened last week, which, it's just all kind of coming together, was these announcements of big investment, as well as Apple's over the weekend coming into the US, companies committing more money being invested here, American made, which does give them more confidence that he will be able to get GDP up, even if we still have some inflation. And to your point, when you see the rates come down as much as they had, 40 basis points over a couple of days, they must believe that those things will be enough, as well as there's some infighting into whether or not they're going to pass all of the administration's hopeful cuts in the tax package and the budget package. They must see that those forces are greater than the likelihood of that inflation high. And to your point, which is a really good one, we need the Treasury rates to come down, both short-term and long-term rates to come down, to cut out so much of the interest on that debt, which is a huge piece. So to your point, I don't remember the exact number, but I know it's over $1 trillion a year that we're spending just on interest. So if you can get that down, even 50 basis points, 1%, and Scott Bessent, is able to do what he needs to roll off certain debt and have new treasuries issued at lower rates, then that goes a long way to righting, righting the error, changing the course, even if it's going to take some time to do it. So that's a really good point.
Yeah, we'll probably know in the next couple of months, but I do think the bond market is starting to price in that they're going to be successful. I call it bending the curve, right? If you look at the debt, it's just like this. But if you could just roll that a little bit, and then you get the tailwind of lower rates and you kind of recycle the debt, that's just going to it's just mathematical at that point.
And the CBO has shown that bending of the curve, the Congressional Budget Office and the administration and Scott Bessent, he has this 3-3-3, we want to cut expenses. We want to get the interest down and basically, get GDP and production going above inflation. And so I think they've been able to show those forecasts and what their plans are, and seeing those forecasts, even though they're still going up, they're getting better, I think is really giving the bond market some confidence that they're serious and that there's some momentum, that they're going to be able to gain, that it reduces the risk premium that they have to have in order to invest in treasuries over time. That's certainty.
The last thing I'll bring in this wonderful conversation, it just happened this morning. You probably haven't seen it, but Scott Bessent, U.S. Treasury Secretary, actually said that the U.S. economy is very brittle under the surface. And I just thought that was the perfect word, brittle. Yeah. That's a good word.
It is. That is a good word. Yeah, I really like Scott Bessent a lot. He is very intelligent. He's worked with stocks and bonds, and he understands the economy. He really does. And I appreciate too, he's really listened to a lot of what Ray Dalio has recommended. So we've got a guy, in charge of the Treasury that understands the significance of the risks of not getting our debt and our spending under control. And so that is their goal number one, more so than they care about whether they're blamed for a short-term recession. Both sides will blame each other. And the reality we've been on that path, but it is interesting to hear him say it in that way. We don't have the strong economy that everybody has wanted to say. And again, we can argue with that at the aggregate. You and I've discussed this, many, many times. At the aggregate, we have relatively low unemployment, and we have relatively, a very strong stock market. We have consumers that are stretched, to your point. They have been for many, many years, but it is worse, in the last couple of years. But things are not as strong as they should be when the top 10% of income earners are floating 50% of the spending in GDP. And he recognizes that. And I've heard him talk about that, and the fact that if you have consumers struggling, it's why they're so big on the tax cuts continuing. And you have this national growth going, you just cannot win. And he has said this is going to be, this next 2 years is critical to push this stuff through. But he's like, this is going to take 2 to 3 administrations that have the same mindset to get everything right. So he's telling you this is going to be an 8 to 10 year deal. But we've got to do the right things today. And I think the bond market is rewarding their efforts. And hearing brittle might scare some, but I think the bond market is understood. I think the stock market might be a little more spooked by the brittle term because of how many retail investors have pushed through. But it's the reality that the economy is softening. Inflation, is higher than it should be. People are crying uncle. And they've got to do a lot of things that people may or may not like very, very quickly to put us on a stable path long term. I think he's expecting recession, Michael. I really do. But I think they're doing everything they can to try to make it not very deep and not very long, and to get us out of it quickly with some of the stimulus things like, extending tax cuts or extra tax cuts for things like tips and Social Security.
Yeah, I think there's a lot of things that are coming. The last thing I'll say is I really do believe that, unlike President Trump's first term, I think President Trump and Scott Bassett, really, probably Scott Bassett first, President Trump second, they're going to be hyper focused on the 10-year note. Yes. I don't think Scott gives a rat's ass about the stock market, right? He's like, hey, that's where the top 10% play. They're already good. Don't care. The 10-year note is what drives the economy. And right now, my job's to get that lower.
100%.
Yeah, that's right.
100% agree with you. Yes, generally speaking, the Fed and Treasury have wanted a strong stock market. And we've seen the Fed put alive and well when the markets start to react. Generally, the Fed pivots. They kind of can't right now with inflation where it is. But that 10-year coming down is really, Scott Bassett can use a lot of different tools. One of the mistakes, and this isn't, a political statement, but we did a lot of stuff on, basically they can issue short-term treasuries or long-term treasuries. And we've had a lot of short-term treasuries, and the lower that long-term yield gets, the more he can do on the long end of the curve to kind of control where rates are, which impacts the interest they pay on the debt. I can guarantee you they care about the system, the economy as a whole, but it's much more, the bond market is so much larger than the stock market. And if you have a choice to save people temporarily or save the system for the long term, the system needs short-term debt until we're out of all the debt we're in. And therefore, they're going to allow some short-term pain to get us to those long-term treasury rates we need in order to both maintain the US dollar as the reserve world reserve currency, and to keep our US debt to GDP lower. So that's what he cares about 100%. And I think they'll allow a little more pain before, the Treasury and Fed work together for any kind of Fed put, if we start to see a market correction in the stock market, which I do still expect.
Yeah, I think there's a lot of people out there pointing at the stock market looking for pain ahead. But Anna, you and I have talked for 5 years. Each and every week, you have an amazing playlist on this channel. Where can people find you?
Great. Well, you can find me here every week on your show. You can find me on social media at Anna Kelly REI Mom. And if you're looking for real estate and wealth coaching or consulting, you can find me on my website at AnnaKellyInvesting.com and get on my calendar there.
Thank you so much.
Thank you.